Hello, my name is Rob Newman and I am one of the partners at Carter Collins & Meyer, a firm of accountants in North Manchester, Rochdale. We deal with owner-managed businesses across Greater Manchester, Cheshire and Lancashire. And the subject of this little video is accountancy year-end against management accountancy. These two things are fundamentally different, even though some of the skills are often used the same. And they're often confused, particularly in small businesses. Small businesses often see accountancy as an overhead, and I get that, I understand. But they try and make decisions on year-end sets of figures, on the statutory accounts, whereas what they actually could do with is something that actually made more sense on an ongoing basis to allow them to see what's happening within their business. And without seeing what's happening in your business, you are blind. You are running blind and your decision making is limited. So, what is the difference between a year-end set of accounts and a set of management accounts? Well, quite a lot. A year-end set of accounts will be presented in a very particular format, a very structured format. They'll have very specific disclosures and wording in there, whereas a set of management accounts can be pretty much anything you want. The year-end accounts will often be precisely accurate. There will be a thing called accruals and prepayments and depreciation and amortization, whereas management accounts often won't include those things. And they're designed for different things. Year-end accounts are fundamentally designed in small businesses for HMRC. There's also the compliance factor of Companies House, and your bank may well want to see them, or any finance lender that you have in place. But the real user of these things is HMRC to calculate your tax bill. Whereas management accounts are used by you. They're used by you and should tell you the story that you want to see. They won't have, or they may, but they often don't have accruals and prepayments and depreciation and all those other big accountancy terms. They'll often concentrate more on cash flow. They'll look at profitability, but it'll often be gross profits as opposed to net profits. Now, a gross profit is the difference between what you buy something at and what you sell it at, as opposed to a net profit being what you sell it at less every single possible cost that has gone into you selling it. And without a gross profit, a net profit is always going to be bad because you're covering overheads, but overheads are choices. So what you're looking at is a different set of scenarios and a different set of things. And in my opinion, management accounts should often cover the 5 pillars of any business. The 5 pillars of any business being sales, service, standards, people, and costs. And rather than necessarily being a profit and loss account and a balance sheet, they should be split up into sales and service and standards and people and costs, and have things within there, measures, KPIs, key performance indicators, stuff that tells you a story that allows you to make the choices and to run your business. Now, with some of the changes that have happened in the last few years, regulated by HMRC, things like MTD for VAT and coming up MTD for income tax, the production of management accounts is actually easier than perhaps it once was, because a lot of people are now having to keep more records than they once did, and are having to keep computerized records in a way that they didn't previously. And if you're having somebody help with your VAT return, it is not a huge stretch to then have them help with your accounts and to produce a quarterly set of management accounts for you. But if you just get a document through, in and of itself, it's not going to be the most useful thing. So I would encourage you, please, reach out and have a meeting or a chat or a discussion with your accountant. Because one of my things that I often moan about is most of my clients don't actually want to talk to me. In all of my emails, I have a link at the bottom that says, please book a meeting here. And most people don't. The majority of the clients don't talk to us from one year to the next. Whereas we'd love to have that conversation with you. We'd love to have a set of management accounts on a quarterly basis after your VAT return that actually tell you a story, because quite quickly we can sit here and go, do you realize this and this and this? I once walked into a prospect and she told me about 3 numbers of her business. And I said, so that means you've got about 8 staff and are turning over £300,000 a year. And she looked at me flabbergasted as to how on earth I possibly knew that. But what it meant is, how I got to it is, the other things that she had told me had created a mental model that said it must be about this. And you can have that mental model from management accounts. You can know what your gross profit figures are and know what your cash collection is and know what your stock turnover is, and therefore have a real control over what's going on in your business and therefore make better decisions And better decisions will give you more profit. Now, yes, more profit will lead to tax bills and tax planning, and we can start talking about all those other exciting things that we do of pensions and protecting your wealth and everything else. But without the fundamentals of how am I trading, how am I getting on, and what's in it, how do you know? Now, the other key thing that I've mentioned there is to do with timing, because a set of statutory accounts will often turn up 9 months after a year end, which means they're nearly 2 years old by the time that you're actually doing anything with them. Whereas a set of management accounts should be within a week or two of a quarter end. And a week or two of a quarter end over a consistent period of time gives you a real picture of the flow of the business. And indeed, off camera just now, I've been talking to one of my long-term friends and clients about how I'm seeing things happening in the economy. And how I'm seeing things happening in the economy is to do with other people's management accounts. I'm seeing builders slowing down. I'm seeing estate agents holding on to lots more houses than they were before. And I'm getting that because I'm looking at their management accounts on a quarterly basis as to what's happening and how's it going on. And what are their key performance indicators? What are their key things that drive what they do? Now, some of these businesses actually become monthly management accounts. But in truth, for most of the people that are viewing this, monthly management accounts, they are overkill. They are getting too much. But if you're edging 5, 6, 7 million pound turnover, that's a different thing. If you're in the 4, 5, 600,000 pound turnover, that's quarterlies. And as I say, particularly with the introduction of things like MTD, it's so much easier to actually do. You're doing 80% of this work anyway. It's just that little bit further, another hour, and I know we're all pushed for time, but that other hour will give you feedback that you just won't get anywhere else from anything else. So what should be in them? Well, as I say, sales, service, standards, people, costs, the 5 pillars of any business. There should be a measure and a way of seeing those things into it. Some of those are very accountancy. Sales is sales, costs are costs, but people, what would you do on people? Well, some of the things you would look for is days of sickness, staff turnover, the training that you give your staff. How many days have they spent learning new skills for the business? The standards could be complaints that you've received, could be Google reviews that you've had, could be returns that have come into your business. And by physically writing these down, by physically having them on a piece of paper, you can see the trend that goes through. They're not pure accounting measures. They're not debits and credits and profit and loss. They're things that tell you what's going on. Again, within sales, I would probably put things like stock turnover. Now, stock turnover is not a pure accounting measure. It's how many times does you actually shift stuff. It's a ratio of your purchasing against your selling. But if your stock turnover is really slow, it tells you might well have a problem within the business. If you're not selling the stuff fast enough to get out the door, it could be failing, it could be going off, it could be going rotten, it could be falling apart, it could be becoming obsolete if it's technology. So there's many, many measures that you could actually look at in there. But the key thing is these accounts are for you. They're not for the bank, they're not for HMRC, and they need to be tailored to you, and they need to give some thought to you. And I would love that opportunity to sit with you and work out what it is that is best for your business and what you need to know for your business, as would any accountant. So please, take that time, talk to us, come and have that conversation, and let's see how we can make your accounting information more useful to you. My name's Rob Newman, and I am one of the partners at Carter, Collins & Meyer, working with owner-managed businesses across Greater Manchester, Lancashire and Cheshire.